Chapter 15 looks at inheritance tax, and this is a tax that arises when somebody dies, and it's normally charged on the estate of the deceased person. So when somebody dies, they look at all their assets, see what they've got, what money they've got, whether they've got a house, if they've got any valuable assets like a car or maybe some jewellery, some investments, and they put a value on this. At death, it's charged at a flat rate of 40% on any estate that exceeds what we call the nil rate band. And we'll do more about this later on, but basically, if we look at the rates tables that you get in the exam, the first 325,000 of your estate effectively is taxed at zero. So you will only have death tax to pay if your assets are worth more than that. The problem is that people might be encouraged to try and avoid this death tax by giving their wealth away before they die, because they might think, oh, well, if I keep all my assets in my own name, if they're all worth more than 325,000, whoever gets them is going to have to pay tax at 40% on them. So they might start to give their assets away to other individuals, or maybe put them in a trust for somebody during their lifetime. So the other thing that IHT does is it will also tax any lifetime transfers that are made in the 7 years before death. So if you give your assets away when you're young enough and you survive more than 7 years, then that's absolutely fine. Nobody's going to pay any tax. But if the transfers took place in the 7 years prior to your death, and let's face it, nobody actually knows when they are going to die, then it might be subject to IHT. Now, this is quite a complex tax, and at this level, you're only expected to have a basic understanding of it. So there is quite a lot that you could sort of go through on IHT, and I'm just going to cover the basics really that you need to know as far as your exam goes. So you're not going to get a big question on this, it'd just be a small amount of marks, maybe a multi-choice or a small part of a question where you've got to deal with a situation where somebody has died. We've got considering whether they're going to have to pay IHT. So we've got the rates table here that you would get in the exam. So as I've said, the first 325,000 is not going to be taxed effectively, no tax if it's at 0%. Anything above that will be taxed at 40% at death, and if it's taxed in a lifetime, it would be at 20%. Now there is something that's called taper relief, where you get a reduction in the tax the longer you've owned it. So if you sort of look at this, if I've had the asset just outside the 7 year period, so it's just become chargeable, if I'd lived a little bit longer than it would have passed the 7 years and been exempt, then you do get an 80% reduction. So the closer it is to the death, the more you're going to get charged, and the further away from the death, the less you're going to get charged. But as it says there, this is not examinable, so I'm not going to be doing any examples on this. And this is something that you will look at if you choose to go on and study tax at a more advanced level. So if we go over the page then and look at the basic ideas of what is IHT. So it's where you've transferred something of value by a chargeable person. And there are two occasions this can happen. During your lifetime, so you might be planning for your death as such. I know that sounds a bit morbid, but starting to give your assets away during your lifetime. Or of course on death, where you've died and you've got a value in your death estate that you give away in your will. Now it mentions here it's a transfer of value, so we need a definition of what that means, and this is where there is a diminution in the value of your estate, or in simple terms, your estate falls in value. So you might have had assets worth, say, 200,000 or 500,000 or £1 million, and you've given some of it away, so now it's worth less. That would be an example of transfer of value. And we'll look at it with some numbers in a minute. During your lifetime, you have a choice of how you make transfers, should you wish to do that. A gift to another individual, so that's a person giving some money away to another person. So you might decide to say give your children some money, or it might be say to grandchildren or a friend during your lifetime. And then the other alternative is a gift to a trust. So this is where the individual is putting some money into a trust that somebody will get under certain situations in the future. So you might say, well, rather than giving the money directly to your grandchild, you might say, I don't know, when you get to 25, this money will then be transferred to you. We have got a definition of what a trust is. It's a legal agreement that you set up where you have the trustees, the people who are going to benefit from something in the future. So you might put some money, say, in a trust for all of your grandchildren. Somebody will look after that, and at some point in the future, the beneficiaries, the trustees will get their share of the money. So the people who are going to be paying this IHT will either be the individuals or the trustees, depending on, you know, who is going to benefit from the situation. Chargeable persons, we're dealing with individuals, so there's no such thing as sort of IHT for companies or anything like that. It's an individual's tax. Spouses and civil partners will be taxed separately, but any transfers between each other will be exempt. So, for example, say the husband died and all of his estate passes to his wife, then that's not going to be chargeable. It's only when it goes out of the relationship that tax starts to get charged. Now, there are some exceptions, so some situations when IHT won't arise. The first one we've got there is no gratuitous intent. So you're not intending to profit. And the example we've got there is when you sell something for £1,000 and it ends up being worth £10,000. So you never intended to make any money, it just sort of happened. In the normal course of trade, so gifts to employees would not be subject to IHT. And then family maintenance, you know, let's say a grandparent says, well, I'll pay all of their school fees or something like that. That would not be subject to IHT. What is an exempt transfer? So this is during the lifetime as well as death. The main one you're going to come across is the first one. So if any partners transfer money between each other or any assets, let's say they transfer their house or some valuable jewellery or something, then that is not going to be subject to IHT, either in the lifetime or at death. There are some others there, but that's the one that we generally see the most often. So what happens then when you transfer something of value? Now we're going to put some numbers to this in a minute, but when you're looking at capital gains tax or income tax, we're always interested in how much the taxpayer has made. So we always think about it, don't we? What was their profit? So if you go back to the previous chapters when we were doing capital gains tax, we say, well, what were the proceeds, what were the costs, and therefore what's the gain or loss on this situation? And that's the amount that will be subject to your CGT. When we look at IHT, we do look at it from a slightly different perspective. We don't look at what the person has gained, we look at what's been given away. So what's our fall in our estate? What are our assets worth before and what are they worth now? And we've got a more detailed explanation of that. But basically, it's this falling value that we're interested in. So the easiest way to probably understand this is actually get some numbers into a situation. So this is quite a simple IHT scenario that we're going to look at. And we're actually going to look at this scenario from both the aspect of IHT and capital gains tax. So we're going to look at what would the value be that we would calculate IHT on if it was subject to taxes, and what would we use if we were trying to do it from a capital gains perspective. So if we look at the situation then, Francis owns 6,000 shares that represent 60%. So at the moment, Francis is falling in this bracket. All right, this company says that if you own between 51 and 74%, you have got shares that will be worth £52 each. So let's make a note of that then. So for IHT purposes, we're going to look at the value of the estate, and estate just really means assets prior to the transfer. So I've got 6,000 shares, and that is each valued at £52. And remember, it's £52 because it says up here those shares are worth 60%, and that's your shareholding falls in that brackets. So prior to giving some of your shares away, your estate is worth £312,000. Now, Mr. Francis decides to give some of these shares away to his son, and he's giving 2,000. So if 6,000 is 60%, 2,000 must means he gifts 20%, and therefore he's left with 40%. And that 40% is now going to come in this bracket. So it's quite common that the less shares you hold, the smaller the percentage, the less control you've got, and therefore shares might not have the same value as they did before. So 40% comes in the 26 to 50% bracket, and each share is worth £30. So let's write that down. So value after the transfer, he's now got 4,000 shares because he's given 2 away, and they're valued at £30 each. And that gives them a value of 120,000. So we can see this is how his estate has changed. So the difference represents the value of the transfer. So that 192,000 potentially might be open to IHT. I know it doesn't say anything here about him dying, but basically he's given some of his estate away. So should he not survive 7 years, they will go back and look what he's been given away in the last 7 years. So that might potentially be subject to IHT, depending what the value of the rest of his estate is. Of course, if it's below the 325,000, then there won't be any tax, but we don't know what else he's got here. So that's the IHT implication. Now, part B is asking you to think about it from a CGT point of view. So IHT looks at what you gave away, i.e. fall in value, whereas CGT looks at what's been made, what profit. So if you were doing a CGT calculation, all right, you would be looking at the gift itself. So you gifted 20%, which was 2,000 shares. And you'd be looking at what those are worth in market value terms, right? Market value because they're free, aren't they? And it's to a son who's a connected party. So any connected party, we always look at market value. So if he gives 20%, that's going to fall in this bracket here. So each share is only going to be worth £18. So that will give the shares have a value of 36,000 if we were doing a CGT calculation. The final point is just saying, how would this be different if he gave the shares to Ben, and rather than be completely free, Ben gives him £20,000, right? And this is from an IHT point of view. So what we're saying is, well, this is what the situation was before. Would it change if Ben gives him some money? Well, clearly the amount he's given him is not market value, right? The shares are worth a lot more than £20,000, as we can see there. So what they would do is they would take the transferring value, which is 192,000, but they would deduct it with any consideration. So because he's paid some money for it, then the figure for IHT purposes would be reduced, which is fair enough, isn't it, if he's going to pay something towards it.